Hello there. 2Cents Capital brings you to a subject of our structured products. Welcome to our channel. In this video, we are going to talk about Autocall Notes. The information in this video is for educational purposes and not financial advice. An autocall investment belongs to the yield enhancement investment strategy. An autocall is an investment that can mature early on a predetermined observation date before its final maturity, and which offers a chance for investors to receive regular coupon payments throughout the life of the investment. In this video, we will be looking at a 12-month autocall with a 12% per annum coupon, linked to the stocks of Coinbase, Amazon, and Nvidia. The strike date of the investment is the date when we record the starting level of the underlying assets. The dates that the investment can automatically redeem early and pay coupons are called observation dates. Let's look at the key features which you need to understand with this investment. The coupon feature. An autocall aims to make coupon payments to investors even if the investment does not redeem early, as long as the worst performing underlying asset remains at or above a certain level. This level is called the coupon trigger. For example, in this scenario, scenario 1, let's assume a product with a coupon trigger of 75% and quarterly coupons of 3%. In this scenario, the worst performing asset is above the coupon trigger on all observation dates. This means that investors will be paid the maximum possible coupons. In this scenario, scenario 2, the worst performing asset is above the coupon trigger for the first 2 observation periods and on the last date, but falls below the coupon trigger on the 3rd observation date. This means that investors will not receive any coupon on this date. Now let's look at the early redemption feature. Whether or not the investment will be redeemed early depends on the performance of the worst performing underlying asset in relation to a predetermined level. This level is called the autocall trigger. If the worst performing asset is at or above the autocall trigger on one of the observation dates, the investment will redeem early, and the initial investment is returned to the investor in full. For example, in this scenario, if the worst performing asset closes at or above the autocall trigger on the first observation date, the investment will redeem early, and the initial investment is returned to the investor in full. If it does not redeem early, it will continue for another period. In this scenario, scenario 2, if the worst performing asset closes at or above the autocall trigger on the 3rd observation period, the product will redeem early, and the initial investment is returned to the investor in full. In scenario 3, if the worst performing asset does not close at or above the autocall trigger, it will continue until its date of maturity. Now let's look at the capital redemption feature. The maturity date is the final date which the investment can mature if there has been no early redemption. On the maturity date, it will also be determined if you get your full investment back. We once again look at if the worst performing asset is at or above a certain level. This level is called the protection barrier. If the worst performing asset is above this level, you will be repaid your original investment amount in full. If it is below this level on the maturity date, you will get back less than you invested. In this scenario, scenario 1, the worst performing asset has fallen by 20%, but is still above the protection barrier on the maturity date. Therefore, investors will be repaid their original investment in full. In this scenario, scenario 2, the worst performing asset is below the protection barrier. Therefore, if it has fallen by 50% on the maturity date, then investors will receive the worst performing stock or its equivalent in cash. Thank you for watching. Please do visit our website, www.2centscapital.com.